Energy has been the underperformer this year, the second worst performer, up barely 1%. And our next guest is taking a deep dive into one name in that sector, Occidental Petroleum, nearly 20% down on the year, but got a boost last week when Berkshire Hathaway upped its stake in the company. Here for more is Mike Khouw. He's the chief strategist at Open.Interest.pro. Mike, I'm so glad you're tackling this one. It's a hugely controversial, not controversial, but everyone scratches their head about it. How could Buffett pick a name that's done so poorly and stick with it? What do you think is going on here?
Yeah, I mean, obviously the energy sector, as you pointed out, it's had a tough year. It has underperformed. And this, even within the sector, is actually one of the names that has underperformed even more than the group has overall. You know, a couple of reasons for that. I mean, oil prices really haven't gone anywhere, and that's largely because the energy markets are very well supplied. You know, you have the United States, and our demand has remained essentially flat, and in a lot of other places that's also true. All of that's going on with the backdrop of North American oil production being essentially at all-time highs. I know that there was a lot of talk, of course, with the incoming administration that it would be more energy friendly, but right now we are already the largest producer in the world. But, you know, I also think that, you know, we're probably going to see this supply-demand dynamic remain relatively stable. And in a lot of other areas of the market, they've appreciated largely because we've seen valuations rise. So the turn on earnings or the turn on free cash flow has gone up. This is actually a case where basically the valuations have largely remained the same. So it's trading a little less than 15 times forward earnings, probably have a free cash flow yield somewhere in the neighborhood of about 8%. So it's reasonably valued here. And, you know, there are ways to play it, I think, if you think the oil markets are going to remain stable.
So that's what I was going to ask. There are a lot of people who've been frustrated with their energy trades, might feel like throwing in the towel. Others might think, well, maybe it's now the time to look for value. How would you be trading Oxy or other names in the space?
Yeah, I think one of the ways that you can look to play it if you're going to be interested in using options and also collecting a little bit of premium, a lot of these names tend to be good dividend payers. They're good yield stocks. And another way you can actually collect some yield on stocks is by selling upside covered calls if you already own the stock. But if you don't, you could actually sell cash covered puts. In this case, I was looking out to the February 7th weekly 47 strike puts. You could collect about $1.20 a share for those. Worst case, you're going to own the stock at that $47 strike price, less the $1.20 you collect, which is going to be about $45.80, which means your basis in the stock would actually be lower than Berkshire Hathaway, so a relatively attractive entry point, if you will. And you're going to collect about a 2.5% standstill yield. So that's 2.5% of the current stock price between now and February 7th. You annualize that, and that's pretty attractive. And one reason I picked the February 7th expiration rather than going out to the February regular is that the stock is going to go ex-dividend the second week of February, and they also report earnings at that time. And stocks will tend to be more volatile when they report their numbers. So this is a way to collect some yield before you get that more volatile earnings week.
That's super interesting. And I think a lot of people would understand why you're approaching it that way in particular. Is there anywhere else you're looking across the energy space, or does this one in particular jump out?
Yeah, I mean, I think there's a couple places that people could look. You know, I think the oil service index in general, that hasn't done particularly well. And, you know, you have companies like Halliburton that are in there. They focus largely on North American sort of land oil services. And that remains, you know, a very active space, of course. You know, we're producing about 22 million barrels of oil equivalent in the United States, as I mentioned before, by far the largest producer, significantly outpacing Saudi Arabia. So I think the oil services companies also are probably going to be fairly stable here. There's going to continue to be demand. I'm not looking for explosive growth because, as I said, I think the environment's well supplied. But I think strategies like this one could apply to more than, you know, just the E&P names. This is a diversified E&P, but you could also look to services to do a similar strategy, I think.
All right, Mike, thank you. Appreciate the ideas. Mike Khouw joining us for Market Navigator.